Bring that joy. Bring that joy.
Hello, everyone. Welcome back to Builders Tribes Tech Forward Talk. We're very excited to have you join us again for another amazing episode. We're so excited. We have so many amazing things planned out for you today. For those of you who are joining us for the first time, Tech Forward Talks is a Builders Tribe program. Okay, it's a webinar program. It happens every month, last Friday of every month. 7 p.m. Qatar time, 5 p.m. West African time. Just do the conversions yourself. So Tech Forward Talks is a talk where we bring people who are professionals in the tech industry, who have built businesses, startup professionals, and we get them to give us industry knowledge, current industry knowledge, updated industry knowledge. And we're very excited about today's topic. Today's topic, guys, is very exciting. Today's topic is from idea to investment, legal and funding essentials for startups. And today we have an amazing guest with us today who would be speaking on this topic. Her name is Samantha. I met Samantha almost 2 years now. And the first time I met her, well, we started chatting on LinkedIn and then I met her in person and she was amazing. It was great to hear about her journey and what she's building, even in business, her experience in business and with legal as well. And when we thought about this topic, there was no better person to bring on board to speak about this topic. I was so excited that we have her today to speak on this topic with us. Thank you so much. We'll be bringing Samantha up soon. If it's your first time, we'd like to know where you're listening from. If it's your first time or not, just tell us in the comment section where you're listening from. We'd like to interact with some of our audiences. Tell us where you're watching from. I'd like to give you a shout out in the comment section. Adjui says, let's go. I'd like to give you a shout out. Tell us where you're watching from, guys. This is very important. Okay. So, guys, this session promises to be very, very insightful. Get out your pen, get out your notes. It's going to be very, very insightful. You do not want to miss out on this session. If it's your first time at Builders Tribe on our YouTube channel, this is a good time for you to hit the subscribe button. If you enjoy programs like this, you love sessions like this, where you always come back for knowledge sessions, get to learn updated information from industry experts, this is the right place for you to learn all of that. Hit the subscribe button so YouTube can tell you whenever we have new events coming up. Aji is listening from Qatar. Welcome, Aji. It's a pleasure to have you join us today. All right, guys, we're bringing up Samantha now on stage. Hi, Samantha. How are you today?
Hey, Michael. I'm good. Thanks for inviting me. Excited to be here. How are
Yes,
you?
it's our pleasure to have you with us. So tell us, we'd usually like to ask, okay, it's an icebreaker question we like to ask anybody who is here on this session. You have to tell us, who is Samantha? Tell us about yourself.
Ooh, you told me there's going to be an icebreaker. I didn't expect this type of icebreaker,
We
Feel like
want to
a
start from
job
there.
interview. Nah, it's fine. Who is Samantha? I call myself a professional helper, um, led by faith. I support startups. I've been working with startups for, I want to say, almost 10 years. And I started when I was in high school. Primarily through my high school. As I said, I've just loved helping people in any way possible. And I thought, I love business. When I say I love business, I really love business. And I also like helping people. So it's just a thing of merging my interest and talents. But outside of this, who is Samantha? It's weird because even in my job, I tell people that I get paid to do what I love. I'm someone who's passionate about supporting people and making sure that anything I do it very well. And I'm also very transparent. I tend to go to the gym a lot as well. So I think that's like a side note about I am outside of like my work. and things. I hope that kind of answers your question. But let me know, Michael.
Yeah, that does. Now we know that you go to the gym, and we get to know that you sort of like always love business, which makes it perfect for the conversation we're going to ask. All right, we have some people who tuned in. Eniola is watching from Lagos, Nigeria. Hi, Eniola. We love to see you. Mr. Samuel is watching from Hungary. Hi, Samuel. Welcome. We love to have you here. So we have to dive. So tell us, Amata, what is the most adventurous thing you have done?
Cool. Michael, this you didn't prepare me for these kind of questions, you know.
That's the icebreaker.
Ah, you see, now when you ask me these questions, I now feel like I'm a boring person. But most adventurous thing I've done, I feel so embarrassed thinking about this because I'm just trying to figure out. I'm not an adventurous person. Like when it comes to food, for example, I'll eat rice and stew every day or jollof rice every day. That's the limitation of my adventure. But I think in terms of adventurous thing I've done, I tried to start a business about 3 years ago. Um, it didn't work out, you know. And for me, that was quite adventurous because I'd moved to a new country and I said, let me try something. It was a new product even in Ghana. It was an wache powder. For many people who don't know it, wache is a rice and peas dish from Ghana. And there's a lot of innovation in terms of how we make that ingredient. So let me go to England and try to sell this product. It didn't work out how I thought it would work out, but you know, I guess that was probably the most adventurous thing I did. Many lessons learned. But yeah, that's pretty much it.
That's very exciting to hear. The thing about business people is that business people would always look for something to do wherever they are, and it's so exciting. Trust me, that is very adventurous enough. So I think we have some of your fans from the UK, Birmingham. We have Benia. Hi, Benia. Welcome. We love to have you here. We have Obina. Obina is watching from Norway. Hi, Obina. Welcome. So we will just dive right in from idea to investment, legal funding essentials for startups. Okay. So my first question for you, Samantha, is guys, this is the point where you have to get your pens and your notes out now because Samantha is about to give us very deep insights. Okay. So first question. What are the first legal steps every founder should take when turning an idea into a business?
Okay, so I'll touch on a few points with this particular question, right? And I'm hopeful that people will be familiar with this. But I always say when you have an idea, maybe someone think I'm going to say registration. Registration is not the first thing I actually tell people to do. When you have an idea is pretty much like gold. I call it liquid gold in today's terms, right? Because your idea is your intellectual ability to think about something in a way that may be unique. And so when you say idea, you look at, okay, what are the properties of this idea that I've come up with? What does it entail? How far do I need to go in terms of protecting this idea? Is it something that's very open to the public? Is it a novel idea? You know, so when you're saying things like novel idea, that means you're thinking about, okay, intellectual property. If it's an idea that everybody sells, maybe biscuits, for example, and perhaps we have to think about is IP really that necessary? But there are different aspects to that. Chinedu, I like your comment over there, you know, liquid gold, exactly. So when you have an idea, the first thing is, what is the value of this idea that you're seeing? After you've thought about that idea, you know, that would go into more detail on like IP assets and what kind of registrations you have to do. Then you look at whether or not it's necessary to incorporate the business. Must give a disclaimer that I'm not providing legal advice on this call, but these are just thoughts and, you know, knowledge from experience I've had working with startups over the past 8 years. So going back to that, when you've got your idea, you're probably thinking about whether or not you should go ahead and actually register the company. For some people, I do say, you know, registering a company at the very onset may not be the best approach because sometimes you just pay a lot to register the company if you're not sure how to do it yourself. For some people, it means you're going to legal counsel to do that. The money is not that easy, especially when you're starting off a business. So I always say try and validate your idea before you even go into registering the business. But these are still very important things you need to do, you know, how that's going to be done. If you do have an idea, you're also factoring in the fact that are you running this business on your own? Do you actually have a partner that you're running this business with? All of these trickle down into the type of registration as well of the business. So I've spoken about two main things so far. We're talking about registration of the business and then IP ownership as primary things that you look into. And even when you look at registration of the business, you're also looking at legal structures. You know, what type of legal structure are you going to have for this business or for this idea that you have? I also say most often, some ideas are good, but not every idea is a business, you know. And so you have to factor that in very well into whatever you're doing. And with that being said, we look at basic legal structures. I mean, for many common law jurisdictions, we have limited liability companies, you know, which are limited by shares in most cases. Some people decide to go for a sole trader, you know, registration. Some people decide to go for LLP, depending on the jurisdiction that you find yourself in. Of course, these do differ. In the States, you hear a lot more C Corp, LLC, as you know, terminology when it comes to registration and legal structure of companies. Some people also have an idea and it's an NGO, you know, and that's also absolutely fine. But when you're looking at turning your idea into a business, these are key details you actually have to consider because it can change or break a lot of things for you. For example, you may be registering your company as an NGO, and 2 years or a year down the line, you want to apply for some funding, but they say it has to be a limited liability company. You know, so these are small things that I'd say you have to consider. And then also when you have an idea, I did touch upon the fact that, is this idea something you're running on your own? Are you turning this business into something where you're sole founder, as an example, or do you actually have a co-founder? You know, when you're looking at navigating legal paperwork, you have to also consider founders agreements, because I'll be real with you guys, you know, this day and age, you're seeing a lot of founders separate, and it's natural. It does happen in certain cases, but at the end of the day, you want to ensure that you have the paperwork that sets the responsibilities, the key details for the relationship for the founders from the very onset. So I think just in terms of the main legal steps, I'd say founders should take into consideration is, you know, think about your legal structure. Think about whether or not you're doing this by yourself. You have a founder, co-founder, that is. So that's founders agreements. If you have this idea and it's novel, then we know that IP is ringing, because IP, as I said, liquid gold. You want to protect that and see how that will generate revenue down the line. And you're looking at registering the business as well, you know, all the documentation required, whether you need some regulatory approval, that's all part of turning the idea into a business. And for those main reasons, that's why I say when you have an idea, think about it first. Don't rush into registering a company just because I've got an idea, I want to start the business just yet. So hope that helps anyone who's there, you know, considering these things.
All right, this is very insightful what you just mentioned. And I think that most people, when they think about the business first, most people get immobilized by the idea of, oh my God, I have to register first. You know, but you said so much that hovers around partnership conversations, testing out your ideas first, you know, all the steps that are sort of like essential first before you think about taking legal steps for business registration. Okay. I think this would lead to the next question. Okay. Now, when you talk about testing out ideas first before people begin to think about incorporation, now, how important is it, okay, to incorporate early? Or at what point should someone know that, okay, I've tested my ideas enough, my idea is perfect now, it's time for me to incorporate now? And what kind of mistakes do founders make when they are trying to incorporate their companies?
Hmm. So how do you know when you're ready to actually incorporate your company? That's real interesting, right? Because at the end of the day, you're the founder of the company. No one can come and tell you that you should do it now or you should have done it 3 months ago. You know, it's understanding what your overall goal is and what your journey looks like. You believe, I would say, as founders, you have to believe in yourself, because you can't sit down and wait for somebody else to believe in you before you start doing things. You know, so early incorporation, I say it typically depends. It depends on whether or not you are committed and ready to start this business as it is, you know, because there are also things that you have to factor in. If you registered the business already and maybe you're dormant for 2 years, you know, I mean, that can accrue some charges, you know. So it's things that you have to factor in whether or not you are ready to incur certain costs. I mean, I won't talk about taxes per se, but you just have to factor in, okay, you've incorporated, you're dormant for 1 year. Second year comes, for some countries, you have like a leeway for when you don't have to do certain filings. But after you pass that, you know, the time is pretty done. It's not on your side. So I always say, think about a lot of things, what your plans are for the company. So you've got your idea now. are you planning on actually starting the company, or starting execution of the company in a few weeks or a few months? Have you tested this idea and realized that, okay, this idea is pretty great. I know I'm on, and I'm going to start with this business, and I want to go all in, or I want to give it a shot. Because not the failure of incorporating early or failure of incorporating at all can be also very limiting. So it's balancing what you believe in your idea, the timing of things, specifically in relation to your plans for the company or the idea in general. And then I think, Michael, you also spoke about, when do we know whether the idea is ready to move on to the next stage, if I'm not mistaken. At that point, it goes back to your metrics for validating the idea, and essentially your timeline as the founder of the company. Because I can sit here and tell someone, oh, I don't think you should incorporate your company the first week of your idea being thought of, because sometimes I say founders have a goal, like they want to push something out, and they don't think about anything else. And their mission is just, okay, how do I sell this, or how do I create an app that does this? But there's always that burst of energy at the very beginning. And with time, some things may dwindle off and may take you another year or so. But there are also founders on the other side who start and they're going all out on every single thing. So you have a founder who's building, they said, I'm going to do this. Within 2 weeks, you see them do the next step. Within the next 3 weeks, they do X, Y, Z. So if you're a founder like that, you want to think about incorporation pretty soon. If you haven't done that already, then let's start getting that into the place. But also look at your community or look at your jurisdiction, and try and also see other companies who have been working, who are working or building things similar to what you have done, and see, okay, when did they actually start working on this? When did they register their company? So I think that's what I'd say in terms of how important it is to incorporate early. That's pretty much what I'd say.
All right. Thank you so much for this insight. Okay. And I think one of the things you'd mentioned right now that just resonated with me is the fact that aside from just setting up a business, there's a place of instinct. Okay. As a business owner, you have to sort of like know when is the right time. You can get advice or legal counsel from anybody, but at some point you have to make a decision for yourself and you have to make a call. And this brings me to the next question, okay, on this conversation. And one of the things I sort of like enjoyed when I met you and we're having like a lot of conversations is how like you have experience in the tech industry, but not just the tech industry. You have experience in like regular business world, consumer products and all of that. Okay. So I think this is very important because you can bring like perspective from that industry as well. Now, next question. What's the best way? Okay, this is money is very important. Everyone needs money for their business. Okay, what's the best way to prepare for your first investment conversation?
That's interesting. I'm gonna throw that back to you real quick, Michael. So you might actually join me on the stage. But
Okay,
your first investment conversation, it can go so many ways, right? Is this an investment conversation with friends and family? Is this with a VC, or is this just in general, right? What
okay,
what angle do you want me to go through?
okay. So I think you might want to talk about. So let's because when most founders think about raising money, they first think about other people's money. So let's talk about like places they can raise money from. So starting out from like friends and family, and then to like talking to like regular VCs and angels.
Okay, perfect. So that means we'll take a step back before we get into the best way to prepare for your first investment conversation, right?
Okay.
I always say, as a founder, you want to make, I guess some founders want to make impact, some founders want to make more money, some founders just want to build something, right? And to do all of these things, typically you require some sort of funding. Now, when it comes to investments into founders or into businesses, businesses are not isolated. The person behind the business is so important to how the business can succeed, especially at the very onset. So when you're saying what's the best way to prepare for your investment conversation, you have to look at this. I always tell people, have you spoken or pitched your business to a friend or a family member or a colleague, for example? If your friends do not believe in your vision, it's not a bad thing. But if your friends cannot give you feedback, either you check your friends or you probe further, because you have to. I don't think you have to, but I think it's encouraged to at least get feedback from people that you're familiar with and mix it up with people that you actually have a goal to aspire to reach funds, get funds from. So in terms of what's the best way to prepare for your first investment conversation, I use my friends to test out and validate how that conversation can go, even if they're clueless about making investments and stuff like that. I still practice, and so that means most of the time my friends will probably not understand the space I'm in or I'm building in. And so it means that I have to speak to them in a way that they'd understand, just as an investor conversation may go, because not every investor that you approach has knowledge in your industry, so you have to create that story for that investor to actually understand. Now, as I said, as a founder, your first investment conversation most oftentimes means you're doing this at the very early stage of your company. You may be pre-revenue in many cases. And so it's your story that would sell. In as much as your story is great, people also want returns on their funds. So that means numbers play a very big part. So when you're speaking to anyone about, investment conversations, you're actually starting this process, you want to know your numbers. Because even if your family member decides to invest, I think we've gotten to a stage where not everyone's doing charity. Money is not just being dashed out to a lot of people. They'd invest because they believe in you, but they also believe in the fact that they'd get some returns. So knowing your numbers and demonstrating that to them confidently can definitely help. But again, as I said, practicing with people that you're comfortable with is one way. Also going to other events and just networking with more founders who might be in your similar situation. I feel like that way you get to learn about what's on the market, how people are, how investors are receptive of certain conversations. That way, okay, this particular fund, maybe I'll not approach them directly, maybe I'll build a rapport with them first, a relationship with them first, and then you'd be able to move on from there. With any investment conversation, I always tell people, if you're approaching someone, make sure you're ready, because if someone asks you, okay, what's the total market size for for your industry, or what's the revenue number for this? What do you project in the next 5 years? If you don't have those numbers, that can throw the people off so much that they might not give you a second chance. So I think what I've drilled on at this point is definitely understanding and knowing your numbers, practicing with people close by to you, and also some strangers, because I always say that sometimes you get the most impactful feedback from people that you actually don't know, because at the end of the day, you might not see them again, and they also don't owe you anything. Your friends might be a bit shy to say, oh, this and this, you should have done it this way. But I think in general, just practicing and getting your numbers straight, and also having the relevant documents. So documents or numbers looks like having your pitch deck on lock. Like, not when I ask you for a pitch deck, you're taking 1 week to send it, because that doesn't really look good, especially in this startup ecosystem where everything is quite fast paced. Making sure that if you're going to raise money, that means you have to think about what we spoke about at the very onset, incorporation. You've done everything that allows you to now move on to the first step. So when you're looking at preparing for your first investment conversation, think about what is actually going to happen after this investment conversation. What are you actually anticipating or hoping for? That way, you're not only preparing for this particular conversation, but you're ready for the follow-up afterwards. So yeah.
All right. People are taking notes in the comment section, and people are very excited about it. This is very, very what you just said is simple advice, but I think it's the simple things that people don't do that get them in trouble, or no, and make them not get the results that they desire. I think something that is interesting is how we talked about be ready. You can't take 1 week to prepare your pitch deck when it's asked of you. Some people are just, oh, I'll get back to you, and that's just it. Opportunity is missed. That's very insightful. So I'd like to take us to our next question, which is legal, right? So let's talk about legal, right? So what legal documents are absolutely essential before taking on an investor?
Okay. So legal documents before taking on an investor. At this stage, you should have incorporated your company. Don't play with this, because it can be very costly down the line. So whatever jurisdiction you find yourself in, making sure that you've incorporated it correctly. I use the term correctly because you want to make sure that, depending on what structure you go for, many cases, some people will either do their research on themselves or seek legal counsel and advice to support them in this. That's number one, because most of the time, investors are investing into the company. Like, in terms of the transaction is going into the company's account. Now, corporate governance or governance in the startup ecosystem is very poor, to say the least, but these are like just the primary documents you want to have. You also want to make sure that your cap table is set and is clear, so that it's not an issue of, okay, somebody wants to come on board, but you have no clue what your cap table even looks like. Cap table is capitalization table. So how many shares do you have in the company? Who owns these shares? Is it just you as a sole shareholder in the company where you have 100 shares? Do you actually have the right number of shares in the company? And I use the word right number because sometimes there are recommended numbers of shares that we say people should have ahead of a funding round or, ahead of raising some investments. I'll use this analogy very briefly, and again with a disclaimer that this does not constitute legal advice, but just purely experience from supporting founders across the years. So imagine you have a cake which has literally a whole cake at this point. It's just you eating the cake. That means you're the sole shareholder. But let's say the cake is split into 4 slices. That means 25% for each slice. If all you have is 4 slices, if you give one investor 1 slice, they own 25% of the business. However, let's say the cake was split into 100 slices, right? That means if you give an investor 100, one slice, they literally have 1%. So these are things that is a tricky way, but I think like people have to look into, okay, what is the share capital? What's the total number of shares you have in your company as something to consider before you actually take on investments. And going further into actual legal documentations, you're looking at what type of investment routes are you going with? I think we'll break that down into another question, Michael, if I'm not mistaken. But you want to make sure that you have your resolutions in place. So maybe a shareholders resolution, your board resolution as an example for essential legal documents that are needed before you can take on an investor. And I'll split this up just briefly. Is a board resolution is essentially your board approving you to actually raise a certain amount of money, and a shareholders resolution is essentially giving you the authority to actually allot a certain number of shares. If you don't have this, that means you've not passed the right resolutions or gotten the correct approval to actually take this investment on board. And yes, you may even be a sole shareholder, but you still need to have these on board, because you want to have this in your record and make sure that all your documentation works out well. I think I'll stop on that end and not go any further.
Yeah, that is very deep legalese.
Yeah, I'm sorry.
Guys, you people should notice how Samantha is saying before she starts dropping really deep inside. Like, this is not legal advice. This is just insight. you know, that's how lawyers. We have to make sure, like, yeah, they're being protected. And so everything you've mentioned is very exciting and very interesting, Samantha. Thank you so much for bringing all of this up. Now, speaking of cap table and equity and how much you should look out for, how much you're trying to give out to people, to founders, to investors, to co-founders, and all of this. Okay. Next question. How can founders protect their equity while still making the deal attractive to investors? Because most investors just come to your company and just want to grab as much as they want, as they can grab. Like, oh, let me just give you a 50K check and you give me 50% of the company. Okay, so how can founders protect their self, their equity, their cap table while still making the deal attractive to investors?
Okay, so I always ask founders this question: what is your goal? Do you actually want to own 100% of the cake, 80% of the cake, or even 40% of the cake? Because I think that ultimately would determine how much protection of your equity you're going to, take, or the approach you're going to take to protecting your equity. And so let's say, for example, someone knows that they want to have 80% of the company and they don't want to give more than 20% away, which is essentially what it means. Then for a fact that whatever happens, you're splitting that 20% with multiple, investors or potential investors. And with only 20% of the cake left to share with potential investors, you also have to factor in other things, such as how much would this actually allow me to grow as a company? Do I need to hold 80%? 80% is fine in the sense that for many companies who incorporate with standard articles of association, articles are basically the general rules a company would adhere to, as they've incorporated. you need 75% of voting shareholding to pass a lot of resolutions. So just as I spoke earlier on about board and shareholders resolutions, having more than 75% pretty much gives you a lot of ownership in your company to do a lot of things. But I always say, what is the trade-off? Is owning your company 80% more beneficial where you have financial limitations than actually allowing people to invest into your company so that you can even grow further? So again, let's say me, I know I have the skill sets, I have the insights, but I don't have the finances. I know that with owning 80% of my company, it can take me from point A to D. But let's say I say, okay, I know I need a lot more money and I need these people to come on board, and they're asking for more than 20%. Maybe they're even asking for 40%, which is quite crazy and throws me off. What would that additional 20% I'm giving away? I use the word additional 20% because we did that 80-20 split. What would that actually do to the company? How far would it take me? And I do the math. I'm like, okay, with this additional 20%, which means I'm giving away 40% of my company, it means I can go from A to Z. Like, I will actually run and do that. Lots of founders, some founders will do that. Some founders are very adamant on, I want to own everything. I want to do this myself, so on and so forth. So I think that's the first thing. But now going into how do you protect your equity while still making the deal attractive to investors? This now looks at things like valuation. So valuation was the valuation of the company at that particular raise. Maybe you're raising 2 million and you want to give away 10%. What's the valuation going to be at that point? You have to consider the valuation at that stage so that it's not giving away too much equity from the company if you have a fixed figure in mind. One thing I say is, if you plan on raising funds, I typically realize that founders don't just do one round. Some people do multiple rounds. And so at the very onset of your funding journey, you want to understand, how much equity do I want to give away in total? So let's say over 3 funding rounds. If it's over 3 funding rounds, then you split it up into 3, for example, so that you have a bit of an idea and make sure that you're not giving away, let's use example purposes, you want to give away 40% of the company in total across your 3 funding rounds. You can't give away 40% at the beginning, because by the time you finish round 3, the company is not for you again. You understand? But if we say, okay, we're going to split it into 10, 10, and 20 at the end, or the other way around, it gives you more of an idea of how do you set the valuation in that way that it goes throughout everything. Now, with early stage or earlier investors who come on board, typically they're the ones making the biggest, no, I wouldn't say risk, but they're the ones, essentially it's a risk actually in terms of investing in startups. Is always a risk, so they're ones who are saying that I believe in you, even though you haven't got much to prove. I'm still going to give you a shot. I still want to throw money into the company. So it typically means, in certain cases or most cases, the valuations at the very early stages are typically lower, because as your company grows, the valuation of your company only gets better and higher. The higher the valuation, the more expensive it is to get a piece of that cake, as an example. So sometimes you have people who will give a lower valuation at the very first round, and then they'd have a higher valuation as they keep on going on. I think that is one way to make that attractive to investors who are coming on earlier. And then there are also different terminologies and different things that you can do where you're negotiating carefully. I always say, be careful who you're asking to invest into your company or pitching to invest, because money is good, but sometimes skills and networks are better. So maybe one investor is bringing on 100,000 and is asking for maybe 5%, but another investor is bringing on 60,000 and is asking for 7%. Now that 40,000 difference, you have to value it and see, okay, if I give this person that lower, they buy a lower ticket, but they're bringing on maybe more value. So maybe they're coming on board and they're going to put me in touch with XYZ clients. It means at the end of the day, you're still winning, you're growing your business. But everything for this particular question and discussion goes back to, what do you want as a founder? Is equity the most important thing? Do you really want to have the biggest part of the cake? Or do you actually want to grow your company, to a stage where you'd then be eating and benefiting off the revenue as it keeps on growing?
Thank you so much. This is very, very insightful. And Speaking of red flags, we're going to get to this, okay? And I think when most people hear about startups, everyone just wants to jump and grab money from investors, okay? And really, guys, that's not the right thing to do. You don't just jump at any money you see. Samantha just talked about how sometimes someone has more money, but someone doesn't have as much money, but they're ready to jump into the pool with you. They're ready to be there with you, work with you, support you as much as they can. Before we get to our next question, this is a great time. I see some questions are rolling in already. So this is a great time to prepare your questions. So after the next question or two, we're going to take questions from the audience, guys. I know this is a very exciting topic. Samantha is here with us now. This is a great time to ask her questions so she can answer you. If you have any questions, please prepare them, put them in the comment section right now. This is a good time. And you can connect with Samantha on LinkedIn. She's Samantha A. Mentor on LinkedIn. She's happy to connect with you as well. So back to the question, Samantha. Let's talk about red flags. Okay? I think it's a very interesting one. Red flag. What red flags should founders avoid during fundraising negotiations?
First things first, verbal agreements. An investor will come and say, "Oh, I'll give you 100K, I'll give you 500K," you know, and you don't have it in writing. For me, I would say that's the first red flag. Get everything you have in writing, even if it's an expression of interest. Have that in writing, because one day you don't want to be telling your story, or you don't want to be raising money, and then they say, "Oh, they never actually said this," or maybe they even discuss a percentage, or you agree on a valuation, and they say, "Oh, this was never discussed." Have everything in writing. If an investor tells you, "Oh, you don't need to send it to me via email," or "Let's not bother, let's just shake on this," guys, don't do this. Don't do this. We've seen it happen many times where people are disappointed. Another thing, I wouldn't say it's a red flag, but I'd say it's something to be cautious about, is investors who are constantly asking you to prove something. And I use that word very cautiously. An investor may say, "Oh, when you reach maybe 100,000, or let's say 2,000 people on your," sorry, I'm just seeing Emmanuel's comment. "When you reach 200 people on your socials, let's touch base again." Now you reach the 200. Then they say, "Okay, now when you actually start getting a monthly recurring revenue of X amount, then you also, you go back to them, that you tell them, 'Oh, I've reached this amount that you discussed.'" They now say, "Okay, but now you have to do XYZ." Guys, is a negotiation, is a discussion, it's a long journey, but there are some investors who, they know from the onset that they're not going to invest in your company, and they keep on stringing you on. And so you actually need to be able to identify and weave those out. It's also very easy nowadays where lots of founders speak amongst themselves. And I know founders who have a list of red flag, like either investors, VCs, but certain, I can't share that information, but like it's just speaking about it within your community. Because once you have that, you get to know, okay, this particular investor, they'll just give you, false promises and keep on asking you to do more work, more work, more work. You come back a year later, they'll say, "Oh, they don't have money for you." So I think that's one major red flag I always tell people to avoid, when you're having those fundraising negotiations. Another one is just unreasonable investor control. And so investor comes on board. Firstly, they're not putting that much money in. They want a board seat, they want veto power, they want to have preferred shares. Guys, let's be realistic. You know what you're building. There are some investors where you actually have to look at them and say, "Okay, if this person comes on board, this is how much value they'll bring. Is it worth giving them XYZ? Does it match the value they're bringing into the company?" So it's understanding what type of unreasonable requests that are coming, from, potential investors. Additionally, it's things like maybe you've done your research and the investor has no track record of, I wouldn't say this is a red flag, but again, it's one thing that I tell people to look out for. The investor has a bad record of either not investing in companies like yours, or has no interest in what you're doing whatsoever, and potentially just is in the game for the money. I say it's not a red flag necessarily, but it's something to be cautious of, primarily because when you take an investor's money who is only in it for the money, the pressure comes on you and you alone. As you're focused on building your business, investors typically know that startups, you won't get your returns right away unless, perhaps a unicorn or one of the lucky few. I think it's important to know that certain investors may put too much pressure on you that doesn't really help you in actually getting to your final goal or building your company along the line. Because if you have one investor who's constantly sending you messages and emails asking you for an update on XYZ, why this hasn't been done, was the money they put into your company really worth it? So I think these are three main things that I'd say you want to look into. Verbal agreements, as I said, guys, get it in writing. Unreasonable investor control requests that they make, and then also misaligned interests, I'd say, are like the main ones you should avoid during fundraising negotiations.
All right. One of the things you just said now that that refreshed my mind to how difficult it is to raising money is actually those investors who keep moving the goalpost or who keep moving the map. Like you said, if you get to this, I'll do this, and they just keep frustrating you. And I think that's, to me, that's the worst red flag. you know, they're not ready to assist you. They don't really care. They just want to just keep, like, those kind of people are going to be on your neck for numbers and just frustrate you out of your goal or your vision. So these are very insight. Thank you so much for these red flags. We love them, and I hope that some founders are able to take note of these, and this should be able to help them on their journey. So we have some interesting questions rolling in. Some people are beginning to like, oh my god, the red flags are sending everybody. Cynthia was like, he doesn't understand what's going on, all these red flags. Thank you so much. Once again, guys, yes, you can connect with Samantha on LinkedIn, Samantha Mensa on LinkedIn. She's happy to connect with you. So we have a first question from an audience here, Samantha. This is from Emmanuel. So Emmanuel is saying, when you're speaking everything about legal, it just has to remind people like, oh my God, I don't have a legal team. How do I do this? Okay. So how much of this planning can one do without a dedicated legal team or person? I think you can also get to talk about how like this is also something like you offer as a service as well. I think. Over to you, Samantha.
Okay, so how much of this planning can you do without a dedicated legal team or person? The truth is, some people are able to do it without a dedicated legal team or person. But the real question is, at what cost? Now, when you're doing the fundamentals and starting the foundation of your business, you want to make sure that these small but mighty things essentially are done correctly. I've seen incorporation which were done so wrongly that I just said, why did you guys not just pay? Because you could have solved this so easy, at that stage. And so you can do it, but the question is at what cost? Now, if you do have a dedicated legal team or person, it's understandable that current legal market, traditional legal market typically isn't the most affordable for, smaller businesses, SME startups, but I believe there are lots of legal service providers and also a lot of legal tech providers that actually support in helping startups specifically with a more budget friendly approach or cost plan for the basic legal things you need to do. I'd say and recommend that you actually do get a legal team or a legal counsel, or I want to use the word lightly that even if you have a paralegal review certain things, that can also be very helpful, because you don't want to grow your business or you don't want to start your business and you realize that you should have done one thing at the very onset, which could have easily been identified by a lawyer or easily been avoided if you had a legal person on board. That can cost you so much more down the line. So an example is, let's say you have this amazing idea. You didn't register your IP, maybe you didn't trademark your business, for example, your brand name. Now, 3 months down, or maybe even 6 months after you've launched it, you've spoken about it, someone now takes your name and now does something online. What can you do? Nothing, because typically I say not a lot of founders think about the legal implications of every single thing that you'd need within the business starting it, or essentially just growing it. And in the absence of that, it can cost you a lot more down the line, because where do you now go from there? I know businesses who started off were trading, and then someone said that, oh, by the way, you have to change your company name because this is actually registered by another company. that can cost you so much if you've done marketing, you've spent so much on branding, So I think it's relevant and very important for you to have a legal person on board or a legal team if you can afford it. In the absence of that, there are platforms that actually would support you in, different aspects of the legal journey. So from incorporation to even certain founder agreements. As an example, I currently work at Seed Legals, which is a UK startup or I guess scale up where we actually support a majority of the UK and global startup ecosystem, where we provide legal documents for startups. So anything you need for a startup, you can definitely find it on Seed Legal's post incorporation, that is. And I think that's something that you can definitely check out. So yeah, hope that helps answer your question.
Yes, that was very that was loaded according to first. That's loaded. Thank you so much for that, Samantha. So we have an exciting question from Ajiri. So Ajiri says, now this reverse, okay? What are the red flags investors often spot during due diligence that could cause them to pull out of an investment deal or like a negotiation or a promise they have made?
Okay, so first thing, we'll go back to the main theme of this call, legal. Bad legals, weak legal documentation is a red flag. That can be very, very challenging. Financial mismanagement, there's no record of how you spent your money as a company. Guys, if you're asking someone to invest in you and you can't even record how much you spend on even incorporating a company, how do you really expect them to actually send you money or actually invest in your company? you know, and then things like cap table. And I said this very lightly at the very beginning, but investors generally want to see who actually owns, the business. They also want to see whether or not you've given away too much equity at the very onset. There are some investors who want to be the first investor on your cap table, and so I think those are very three top points that I just say. I mean, weak legal documentation, financial mismanagement, even if you look at things like you haven't figured out your IP stuff, which also goes back into the risks and all, and then also things like poor governance. So as I said, poor governance is currently one of the biggest causes of a lot of failures of startups today and a lot of funds today, which is unfortunate. But I want to use the word is understandable because I know, as I said, founders typically wake up, I have an idea, I want to build, I want to keep on going, but you need to make sure that you're compliant with every jurisdiction that you're operating in. Make sure that you are compliant. If you're building a fintech company, make sure you're compliant. You want to look at anti-money laundering, the data privacy. You just want to make sure that those are things that you're actually having on in your deck, for example, not in your pitch deck, I mean, but just documentation you have ready and available, because these are things that investors will actually look into. And with at the onset, you don't have this in place, it makes it very challenging for them to see, okay, they can't get the basic things in place. How can I trust them with X amount of money? Because what's going to happen if they don't, they pretty much can't manage those things. So yeah, I think those are the main things. I want to drop one last one is an unrealistic valuation. If you go to an investor, you've just started your company and tell them your valuation is 10 million and you haven't, there's no, maybe you're a brand new sector, there's no track record or anything, sometimes it just throws them off because they're like, these guys are not serious, or these guys haven't done sufficient research. So I think you just want to think about these main things, and I hope that's answered your question, Najee.
I'm sure it does. Conversation of valuation. That is so funny. We just started our what's $10 million. Come on. Thank you so much for this, Samantha. Guys, this will have a couple more questions I've rolled in, but we'll not be able to take all the questions. We'll take one last question, okay? I think you'll be able to like reach out to Samantha. You can go have a conversation with her in her DM. And now that she's here, if she makes a promise to you that she's going to reach out to you, screenshot it so that you can go and tell her, you promised me to respond to my DMs, okay? So the next question we're going to take is from Emmanuel as well again. And Emmanuel is concerned okay, about his business and his startup. Okay, Emmanuel wants to know, Are there ways to identify investors who intend to enforce their own agenda on your business?
Hmm. Emmanuel, this question you asked me is very interesting. Are there ways to identify investors who intend to enforce their own agenda? I think in some cases, you do see it from very subtle signs or very subtle comments they pass. And so this can be simple things like, how do you spot microaggression? You know, what exactly are they looking for? What exactly do you identify as their own agenda as well? In terms of identifying, I think it's a pretty challenging one because it's not everybody that you can spot that, oh, this person's coming in, they have their own plan. But I believe there's certain ways in which you can gear the conversation and also pick their mind. Because I say, yes, you need the investors' money, but they also want you. So it's almost like if you have a job interview, I would say don't go and beg someone for a job, like in a general term, but show that you're also bringing value. And if you think that this investor has come on and they're saying, okay, I think you should do it this way, I think you should do it that way, and they're never actually listening to what you as a team want to actually go ahead with, then I think these are some signs you want to actually look into. If they come with unrealistic demands, as we spoke about earlier on, I think that is sometimes, some ways that you can actually identify investors who intend on enforcing their own agenda. But again, it also comes with, if they have that intention, how much authority have you actually given to this investor to execute this own agenda? So this investor comes on board, they have 0.01% of your company, and maybe you've not even given them voting rights in terms, or they literally have no say. I mean, what can they really do at the end of the day, right? So identifying investors who intend to enforce their own agenda in your business comes from you also sense checking the conversations you're having with these potential investors. And as I said, you want to speak to the community, find out from other people, other companies they've invested in, and try and figure out, okay, how's this person as an angel investor? How's this person? How supportive are they, or what's their style? Because at the end of the day, that would help you in identifying and knowing how they work. I also believe that there's some people who perhaps either the way they speak or the way they send an email may not be communicated in the best way possible, vice versa. So it's always important to try and strike that balance and get the clear picture at the very beginning so that you can know how to, I guess, navigate that relationship better. Emmanuel, have I answered your question? I hope I have. And yeah.
Yeah, I'm sure you have. Samantha, Emmanuel has a joke. Emmanuel is saying Samantha would say we didn't capture the inbox reply promise in writing.
You already know, Emmanuel.
But this session is recorded, so. All right, guys. So we have come to the end of this session. We're so grateful. Thank you so much, Samantha, for being here with us. Thank you so much for showing up. Do you have any last words for us? The last sentences and last legal one-liners? Well, aside from this is not legal advice. Yeah.
I'd say to every founder in the room, keep building, believe in your vision, and don't be scared of the legal involved in building in your company or in building your business. Legals are not there to prevent you from growing. They're there to help you and protect you. It sounds a bit weird, but trust me when I say this. It's only meant to support you in making sure that you're fitting yourself into the right box. Or if you don't want to be in a box, maybe find a sandbox, to work on. But essentially, keep on building and don't push legals to the side because it can destroy your company along the line. And I don't think we want to let things go just because of something that we may have missed at the very onset. Invest in the legal team if you can, or find platforms or companies such as Seed Legals, which can actually support you as you create agreements like founder agreements, investment agreements, to support you in making sure you have the right documentation. I think I've said more than one line, but I hope this has been helpful. And thank you so much to the Builders Tribe and to Michael for having me here today.
All right, this was our pleasure. Thank you so much, Samantha. Thank you for giving us value. I will say bye for now until you catch you another time.
Bye.
All right, guys. Thank you so much for tuning in, guys. And we have come to the end of today's session. Okay. And if you have watched all up to this point and you have not subscribed to Builders Tribe, you are wrong. this is a good time. Hit the subscribe button, subscribe to Builders Tribe. Go and tell your friends and family. So we have this session up on our YouTube channel, so you can always come back to it. You can always reach out to your friends and family. Tell them to, anybody who's been in business, tell them to come listen to what we said here. We had so much to share here, guys. Follow us on all our socials as well. Follow us on LinkedIn, follow us on Instagram, follow us on Twitter, Builders Tribe HQ. You can visit our website to learn more about what we're doing. Like I said again, subscribe to our YouTube channel and connect with Samantha on LinkedIn. She's looking forward to your connection and looking forward to reaching out to you. Thank you so much, guys. Builders Tribe out.
Bring that joy.